As a real estate agent, it's essential to keep an eye on economic changes and their impact on housing market. The recent decision by the Bank of Canada to lower interest rates by a quarter percentage point is big news. Let's break down what this means for the economy and, more importantly, for real estate market. So what just happened? On June 5th, 2024, the Bank of Canada cut its overnight lending rate from 5 to 4.75%. This is the first rate cut since March 2020, and it's bringing the rate back to where it was a year ago. The central bank feels more confident that inflation is under control and hinted that if this trend continues, we might see more rate cuts in the future. What's going on with the economy? The Canadian economy is giving us mixed signals. On one hand, consumer spending, business investment, and the housing market are doing okay. On the other hand, overall growth has been weakened than expected. The unemployment rate has edged up to 6.1%, but that it's still close to what we consider full employment. Inflation, especially related to housing costs, has been a major concern. However, inflation rates are now showing signs of slowing down and are nearing the Bank of Canada target range of 1 to 3%. This has given the bank the confidence to start lowering rates. What does this mean for interest rates? While a cut in interest rates is generally good news, don't expect borrowing costs to drop significantly overnight. The Bank of Canada is being cautious. They don't want to cut rates too quickly and risk sparking a new round of inflation. Lower mortgage rates might lead to higher house prices, which could be problematic. Global factors also play a role. Issues like changes in supply chains and geopolitical tension could keep prices high. The Bank of Canada will likely take this factor into account when deciding on future rate cuts. So what does all this mean for real estate? Lower interest rates usually make mortgages more affordable, which can boost housing demand. However, the bank's cautious approach means that we won't see a dramatic drop in mortgage rates. If house prices start to rise too quickly, the bank might slow down or stop further rate cuts to keep inflation in check. For us, real estate professionals, it's important to understand that while the rate cut is positive, the changes will be gradual. This easing will provide some relief for buyers and businesses, but it won't lead to a sudden boom in the real estate market. The next big update from the Bank of Canada is on July 24. This will be the important day to watch as the bank will share its outlook for the economy and inflation. It will keep us understand what might happen next with interest rates. The most important takeaway from all of this for buyers is that price rises in the real estate market in Toronto and the GTA are likely to remain modest throughout the rest of 2024. So if you're thinking of buying, this may be a good season for you. For sellers, you may think this is not a good time to sell for the same reason, that the market is still quiet and price may ramp up more powerfully next year. But as the governor of the bank said in his speech last Wednesday, we don't have a crystal ball, and thus no one, including bankers, know exactly what is going to happen over the next 12 months. What is clear, however, is that very few people inside or outside of banking want to see inflationary pressures gain serious momentum again soon. So prices a year from now are very unlikely to show the sharp rises we saw in 2021-2022. And that is something sellers will want to think about. The pandemic is fading in our rear view mirrors, and we have moved into a new period of interest rates policy and GTA real estate prices. Maybe the old story is true that slower and steadier does win the race after all. Whether you're buying, selling, or just love exploring real estate options in Toronto, I've got plenty more to share. Thanks for watching, and don't forget to like my channel and subscribe for more real estate tips. See you in the next video.